When we think about finance, our minds usually go to assets, markets, and prices, right? But underneath all of that, there's this hidden layer, a kind of infrastructure. It doesn't create money and it doesn't store money. It just makes money move. These are the invisible pipes, and without them, the entire system just grinds to a halt. And this is why this is so critical. Look, when markets are calm, we don't even think about this plumbing. We just take it for granted. But when panic hits, the simple ability to settle a trade, to actually move your asset from point A to point B, that becomes the most valuable thing in the entire world. The pipes literally become everything. To really get why, let's just rewind the clock. Picture New York City before 1853. It's chaos. You have bank porters literally walking through the streets, hauling massive bags of gold coins and stacks of checks from one bank to another. It was risky, it was slow, and it was incredibly inefficient. I mean, mistakes in the books were common, and the whole system only really squared up once a week, on Fridays. Just a mess. But, out of that chaos came this elegantly simple idea. It was one that had already taken root over in London, and it was about to completely transform American finance. This is the story of how the plumbing was invented. So this all started in London, a full 80 years before New York got its act together. Back in 1773, a bunch of bank clerks, probably just tired of running all over the city, started meeting up in coffee houses to settle their books. That informal get-together, it became the London Clearing House. New York copied their model in 1853, and this private sector idea worked so well that when the U.S. government finally got around to creating a central bank in 1913, the Federal Reserve was built on the exact same model. So what was the big idea? The core innovation is something called multilateral netting. And it's brilliant. Instead of Bank A paying Bank B and Bank B paying Bank C and so on, everyone just sends their claims to one central spot. This hub just nets it all out. So if Bank A owes you $100, but you owe Bank A $80, only $20 actually needs to move. It just cuts out all the friction, the risk, and the sheer amount of physical cash that was sloshing around. So how big of a deal was this? Well, on its very first day of operation, October 11th, 1853, the New York Clearing House cleared $22.6 million. And get this wasn't new money. It was the same money that was already in the system, but now it was moving faster, cheaper, and way more safely than ever before. The impact was just immediate and massive. But here's where the story gets really interesting. The clearinghouse's most important job wasn't just making things efficient day to day. Nope. It was its totally unexpected role as a firefighter. It became the first line of defense whenever a financial panic hit. The power this thing had was astonishing. Between the year it was founded and the year the Fed was created, this private institution managed 10 different financial panics. How'd they do it? They invented something called loan certificates. When everyone was hoarding gold and cash, banks could use these certificates, backed by their own good assets, to settle up with each other. It was like a semi-currency that kept the whole system from freezing up. And the result? Just look at the Great Depression. While 8,000 other U.S. banks failed, only a single member of the clearinghouse went under. Incredible. Okay, so this system worked beautifully for a national economy. But as finance went global, a new, much trickier problem popped up. Technology meant money could flash across the world in an instant. But trust? Well, trust couldn't always keep up, especially across different time zones. And this brings us to something called Herstatt risk. So on June 26, 1974, German regulators shut down this bank called Bankhaus Herstatt. Here's the problem. Banks in America had already sent them their German currency for their trades, but because of the time difference, they hadn't gotten their US dollars back yet. The German bank went dark, and the American money, it never arrived. The fallout was a catastrophe. In just the 3 days after Herstatt collapsed, the volume of interbank transfers, the money moving between banks, plummeted by 60%. The money wasn't gone. What was gone was trust. Banks just stopped believing that the pipes would actually deliver. The entire global system just froze. The solution to this Herstatt problem took nearly 3 decades to build. It's called CLS Bank, and you can think of it as the pinnacle of modern financial plumbing. This was no quick fix. It was a monumental global effort that took 28 years. So how does it work? Well, the mechanism is called payment versus payment, or PVP, and it's a beautifully simple idea.
Both sides of a trade, let's say dollars for yen, are sent to CLS. Then, CLS settles both legs at the exact same moment. But here's the crucial part. If one side fails for any reason at all, the other side is automatically canceled. It's impossible to pay out your money without getting what you're owed. It completely eliminates that settlement risk, just by design.
And the scale of this thing is, well, it's almost impossible to comprehend. On a single record-breaking day, CLS settled $19.1 trillion in payments. It's weathered the 2008 crisis, the 2020 pandemic shock, all without a single hiccup. It doesn't create a single dollar of value, it just makes trillions of them move safely every single day. So, why this whole deep dive into 250 years of financial history? Because these exact same problems, these settlement gaps, counterparty risks, these broken pipes, they're all reappearing right now in the world of decentralized finance. It's like déjà vu.
I mean, the parallel here is uncanny. Herstatt risk was all about paying out one currency before you received another because of a time zone gap. Today, when you use a cross-chain bridge in DeFi, you lock your asset on one chain, say Ethereum, and you wait to get a new asset on another chain, like Arbitrum. In that little window of time, if the bridge gets hacked or just breaks, you've paid out your side of the deal, but you never receive the other. It's the exact same settlement failure, just with different technology.
And the price tag for these failures is staggering. These huge exploits on Ronin, Wormhole, Nomad, these weren't failures of the assets themselves. The value was there. The problem was that the pipes connecting them just broke, and that led to over $1 billion in losses. Plain and simple, these were settlement failures. And there's another parallel too. Remember the clearinghouse's loan certificates? They were basically private claims on collateral. Well, today's wrapped tokens in DeFi are also private claims on an asset held by some custodian. But here's the critical difference. Those old loan certificates were backed by strict membership rules, by audits, by mutual guarantees from all the other banks. Wrapped tokens today, they're backed by, well, far, far fewer safeguards. So what's the big takeaway from this whole journey through financial history? What are the lessons from 2.5 centuries of building these invisible but vital pipes?
I think it all comes down to this. For any asset to be truly liquid, it has to pass 3 tests. First, is the market deep enough to actually sell into? Second, is there some kind of backstop if there's a crisis? And finally, and this is the one everyone forgets, do the pipes actually work? That settlement layer is the crucial third dimension of liquidity risk. Can you actually move your asset? You know, on June 25th, 1974, nobody was worried about settlement. The very next day, it was the only thing that mattered. And that really is the central point here. The infrastructure for moving value is every bit as important as the value itself. Without reliable pipes, your asset might be theoretically valuable, sure, but it's practically worthless if you can't move it. It stops functioning as money.
And this leads us to a final, maybe uncomfortable lesson. The institutions that survived everything, world wars, depressions, pandemics, you name it, they were the boring ones. The London Clearinghouse, the New York Clearinghouse, CLS Bank, they focused on being reliable, not on flashy returns. And in DeFi, the projects that are going to last for decades will probably be the ones building that same unglamorous, boring, but absolutely essential settlement infrastructure.
So I'll leave you with this question to think about. The world of decentralized finance is innovating at a blinding speed, right? It's creating all these new assets and new ways to create value. But is it learning the 250-year-old lesson about the importance of the pipes? Is it actually building the boring, resilient plumbing it's going to need to survive its first real systemic crisis?